Hello and welcome to Adjusting Entries, Part 3, Equipment, Depreciation Expense, and Accumulated Depreciation. I'm Bennett Tchaikovsky, and this is my disclaimer and copyright notice. The information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. I encourage you to share this presentation and share links to this presentation on an unmodified basis. If you do modify the presentation in any way, please email me prior to doing so at 1812cpa@gmail.com to discuss. Note the author does not claim any copyright whatsoever on any companies or organizations mentioned in this presentation. Rather, the other parties are the owners of their respective copyrights. So right over here, we're now talking about, we're going down the list. The prior two videos covered on a simplified and a more detailed basis, cash and loans payable, and then here we've got equipment, what happens when we buy equipment. So again, when we're looking at adjusting journal entries, and really when we're purchasing equipment, that equipment is an asset. Once I start using the asset in my operations, then what I need to do is I need to record that particular cost of that, or the use of that equipment. And the way I'm going to be doing that is through depreciation expense. So that's what we're going to be focused on today. So when we're doing adjusting journal entries, we always want to ask ourselves these questions. Once the initial transactions are recorded, and here for the equipment, what's very important is that do the assets reflect the future economic benefit? If I purchase equipment brand new and I've been using it for a year, and if I don't do any kind of adjusting journal entries to reflect that use, I'm essentially misstating the information on my financial statements because that equipment no longer may have that particular value. So it's really important that we go through and record the related expenses of using that equipment, and that do our expenses reflect the benefit that we receive for that item used, which is the equipment during the period. Note here is that we're going to go ahead and record the equipment, but we're not going to make any type of adjusting journal entries until after we've recorded everything initially into the T accounts. Remember, your first step, record all the transactions into the T accounts, and then at the end of the period, we're asking ourselves these four questions. Note here, we never make an adjusting journal entry that involves cash. Okay. How do we depreciate equipment? So when we're purchasing equipment, equipment generally is giving us a long-term benefit over a period of time or years. Therefore, we need to allocate the cost of that equipment over the asset's useful economic life. This is done by what we call depreciating the equipment. Essentially, and additionally, some property, plant, and equipment will continue to be used after the cost allocation has been fully made or that they have been fully depreciated. Therefore, when we record the transaction, we're going to be using what we call a contra asset account in the form of, in the name of, accumulated depreciation that will reduce the asset's carrying value on the balance sheet. There are many methods of depreciating equipment, and I have later videos that go through that, including double declining balance and units of production. We are focused here on straight line. When I'm doing adjusting entries, I like to kind of layer everything. We're going to talk about equipment in a later section, but right now we're just getting a basic understanding. So how do we compute depreciation expense? We take our asset acquisition cost, or that cost of getting that asset ready for its use. We subtract from that the salvage value, or the amount we're estimating we can sell the equipment for at the end of the asset's useful life. We're dividing that by the estimated useful life in terms of years, and then this is going to be giving me my depreciation expense per year. Now, note here, salvage value and estimated useful life are both estimates. For salvage value, if we had a car, we can maybe go and say, well, what's this Honda going to be worth in 10 years? What is this BMW, excuse me, the ultimate depreciating machine, excuse me, the Bavarian meat wagon? What is this? Oh, it's zero? Oh, yeah. So that right there is my salvage value. That's a joke, by the way. Thank you. I'll see my new 3 Series on my doorstep, and I'll go right on to Mercedes. Or actually, my friend, Calvin Hutchins, is a great lemon law attorney out here in California. His favorite one is Land Rover because he gets a lot of clients from Land Rover. So that's probably the ultimate depreciating machine. In any event, so I'm dividing this here by my estimated useful life. So the salvage value and the estimated useful life are both estimates. So, but we're just going to try to make our best estimates. The important thing about depreciating equipment is we can never depreciate beyond the salvage value, or what we call the net book value, which is equipment less the accumulated depreciation must never go below the salvage value. So again, that's one thing to keep in mind. Now, can we fully depreciate an asset and continue to use it? And that answer is yes, it happens all the time. It's just that when we're going through and recording it on our books, it's just going to be staying there as long as we continue to use the asset. So after we've determined the amount of the depreciation expense per year, basically over here, this is essentially would be for partial period. Okay, so the way we do the transaction in terms of T accounts, we're going to basically go right here. We're going to debit depreciation expense, and then we're going to credit accumulated depreciation on that equipment. And what's really important is what happens with this expense. Well, this expense is going to be included on the income statement. Why? It's an expense. And over here, remember that we have DCER-AELOE. We're debiting the expense. So what's going to happen with this is that this is going to go onto the income statement as an expense, and then it's ultimately going to be closed out to retained earnings. Now, accumulated depreciation on the equipment, this is a little bit different. This is something we're calling a contra asset account. And it stays with the asset, but because it has a credit balance, and remember, most assets typically have debit balance, but because this has a credit balance, it's going to be reducing the carrying value of that equipment. So we're going to see essentially, we're going to have the asset or the property, plant, and equipment minus the accumulated depreciation on the equipment will give us property, plant, and equipment net. And that's what we'll be going and seeing on our financial statements. So once we've gone through and we've recorded the depreciation expense, then we're going to have like essentially these 2 related accounts showing up here. And this is what's going to be closing. And we don't close out these accounts to retain earnings. Why? These are permanent accounts. We only close out expenses, revenues, and dividends. Property, plant, and equipment and accumulated depreciation on that equipment are both asset accounts. This is an asset account, has a debit balance. We call this a contra asset account. And so that you kind of see how this kind of looks, as of right here, this would essentially be property, plant, and equipment less the accumulated depreciation on the equipment. Remember, this has a credit balance, so it's reducing reducing the carrying value of this property, plant, and equipment. And this will give us property, plant, and equipment net. And this, what does net mean? It means the property, plant, and equipment net of accumulated depreciation. If you see most companies on their balance sheets, they'll just show property, plant, and equipment net. Sometimes they will go through and show the full amount of the accumulated depreciation. It just depends on how significant the numbers are. But again, right over here, property, plant, and equipment net. So what does net mean? It just means property, plant, and equipment less the total amount of depreciation that we've taken to date. So what happens the following year? So once we depreciate an asset, okay, so once the year is over, the depreciation expense is closed out to retain earnings. Remember, it's an expense. However, the accumulated depreciation balance is not closed out. Rather, the ending balance from one year becomes the beginning balance of the following year. Now, using this over here as an example, this ZZZ, if we start the next year, I've got ZZZ, which is my beginning balance, and then I'm adding in depreciation expense for the second year. By the way, this is not a tribute to ZZZ Best, which is by far Barry Minko, biggest scumbag of all time. So, or he ranks up there. And so there you go. He's a guy who used God to steal money from people. He's going straight to hell. So there you go. So I've got over here my ZZZ, which is my beginning balance, plus my depreciation expense, or what my entry was here. And then this over here would be giving me my ending balance. When I use A/D, what does that mean? It's an abbreviation for accumulated depreciation. Okay, so now what we're going to go through is we're going to do an example. And this is going to be a full comprehensive example. And I'm going to put this onto a Google Sheet, and we'll kind of go through it. But let's just look at this right here. So on January 1st, 2019, I purchased equipment costing $140,000 by paying cash, and the equipment is immediately put into use. The equipment is estimated to last for 3 years and will have a $50,000 salvage value. We depreciate using straight line. And what we want to do here is we're going to prepare the T accounts to record the purchase on January 1st, prepare the adjusting entries required on December 31st, 2019, December 31st, 2020, and 2021, 2022, and then the balance sheet presentation for equipment. So I'm going to put this into a nice little Google Sheet, and we're going to start our party right now. Okay, and we're back. So on January 1st, 2019, ABC purchased equipment costing $140,000 by paying cash. So we're going to go ahead and record that here on January 1st, 2019. And the reason why I'm doing it this way is, do we actually purchase equipment on New Year's Day? The answer to that is no, we don't. However, because of, to make your lives a little bit easier and not recording partial period depreciation, I'm just doing this for the full year. I have a later video just covering straight line where you can go through and see that. So right here, when I'm buying this equipment, I'm going to be debiting equipment for $140,000. And here, I'm going to be crediting cash for $140,000. Now, when I come to the end of the year, I'm asking myself the question, as of 12/31/19, do my assets reflect the future economic benefit? And do my expenses reflect what I've used? Well, since I bought this piece of equipment and I put it into use, I need to record what we call depreciation expense. And the way I'm going to do this is I'm going to show over here a debit to depreciation expense, and I'm going to be crediting accumulated depreciation on the equipment. Okay. Now, how do I determine the amount of the depreciation expense? What we've said is if you go back and look at the earlier part of the video, we've got our acquisition cost less our salvage value divided by the estimated useful life. So for right here, this acquisition cost is $140,000 minus the salvage value of $50,000. And my estimated useful life here is going to be 3 years. So when I take $140,000 minus $50,000, what I'm going to be getting is $90,000 divided by 3, or a total of $30,000 of depreciation expense per year. So that's how I'm going to depreciate the asset. Because I'm using straight line, it's going to be the same amount year over year. Now remember, this is for 12 months. So since I bought this asset from January 1st to December 31st, this is going to be 12 months. So I'm going to multiply this here by 12, or for a total, 12 divided by 12 is going to be 1. And so this is going to be for the full year. If I had bought this asset on March 1st, what I would have to do is multiply this here by 10/12. Why? Because March to December is 10 months. Close your eyes and count. March, April, May, June, July, August, September, October, November, December. That's my accounting bird box challenge, which you don't want to do. Maybe you shouldn't be an accountant if you're doing the bird box challenge. Okay, so right over here, I've got 30 grand. So what I'm going to do here is to record the depreciation expense. I'm going to debit this because I record expenses with a debit. So I'm going to basic over here and debit my depreciation expense for $30,000. I'm going to credit accumulated depreciation on the equipment. Now, what's very important to remember is that accumulated depreciation on the equipment is a contra asset account. It reduces the carrying value of the particular equipment. I do not credit the equipment for $30,000. That is not correct. I have to show this separately. And the reason is even after the equipment is fully depreciated, I still may be using it. So I need to keep it on my books. It'll show up as being fully depreciated, but there you go. So this is my entry as of 12/31/19. So my ending balance here is going to be $30,000. Now, what happens with this depreciation expense? Well, for the year ended December 31st, 2019, it's going to reduce our net income. It's then going to be closed out to our retained earnings. But what happens over here with this, my ending balance here on 12/31/19 is $30,000. So what happens over here is I'm going to be showing my equipment with a cost of $140,000 minus or less, and this is going to be on my balance sheet, $30,000, which will be giving me equipment net of $110,000. I'm only doing this as a partial balance sheet. And where does equipment go? On our classified balance sheet. It goes below current assets. It is a non-current asset because it's giving us useful life beyond a year. And at the same time, it's not something that's going to be expected to be liquidated as we're going through and we are using it in our operations. So this is what the balance sheet presentation for non-current assets would look like. You would have equipment, less accumulated depreciation on the equipment is giving you here equipment net. So let's now go to the second year. So for the second year, my accumulated depreciation balance is still going to be with us. And then at the same time, I'm still going to be recording depreciation expense for that next following year. Now notice here, because my asset accounts, and I'm going to make this a little bit, so for 2020, my equipment balance is still going to carry down. Why is that? It has, it's an asset, so it's a permanent account, so that's not going to change. My depreciation expense here would have been closed out to retain earnings, but here my ending balance on December 31st, 2019 becomes my beginning balance for the following year. So over here, when it comes to the depreciation expense, what do? Well, I would calculate depreciation, but because I'm doing straight line, it's going to be the same every single year. So over here for 12/31/20, what I'm going to be recording here is $30,000. Now, my journal entry to record depreciation expense never changes. It's always going to be a debit to depreciation expense, and then it's going to be a credit to accumulated depreciation equipment. So this here is my, essentially my depreciation on that asset for the year. So I've gone through and I've recorded the depreciation expense, which here is going to be a debit to depreciation expense of $30,000, and then a credit to accumulated depreciation. So what would happen at the end of the year is that depreciation expense would get closed out to retain earnings and go to zero for that period of time because it's showing us what we use for a period. However, our accumulated depreciation balance, our ending balance is now $60,000. So over here with my equipment having a value here of $140,000, less my accumulated depreciation of $60,000 gives me equipment net of $80,000. Now, one thing I have to keep in mind is that one of the things we discussed earlier is about salvage value. So I'm showing this equipment on my books at $80,000. Now, my salvage value is $50,000. So I can depreciate up to salvage value. So I'm still okay. So as long as salvage value is greater than, or I should say is, let's see here, as long as equipment net is greater than salvage value, we can continue depreciating. So over here, my equipment net is $80,000, which is going to be greater than $50,000, which is the salvage value. Okay, so the next thing we're going to do is now we get to 2021. Well, what happened to the depreciation expense in 2021? Well, that balance got closed out to retained earnings, so this one's gone, and now we start fresh. But my accumulated depreciation on my equipment, my ending balance here as of 12/31/20 becomes my beginning balance on 1/1/21 here of $60,000. So now, what did I do during the year? Well, I have to depreciate the asset. Well, if I'm using straight line depreciation, it's going to be the same amount every single year. That's why we call it straight line. Or over here, it's going to be $30,000. So as I look here in terms of saying, okay, so I've debited depreciation expense, I follow my same pattern, which is I'm crediting accumulated depreciation on the equipment. So this is going to be 1/1/21 through 12/31/21 because we've used that asset over a period of time. And so now my ending balance here is going to be $90,000. And if we think about this, we've now used this asset now for its full useful life, or 3 years. We had it over here, it's got a useful life of 3 years. So here is year 1 of the depreciation, here's year 2, and here's year 3. So when I go to my balance sheet still shows equipment here of $140,000. Remember, I don't touch equipment once I buy it. I show the reduction in value or the useful value to that via accumulated depreciation. Here, my accumulated depreciation on my equipment had an ending balance as of 12/31/21 of $90,000. So my equipment net right here is now $50,000. And my equipment net is equal to my salvage value. So what I need to do at this point in time is to stop depreciating, because I cannot depreciate an asset beyond its salvage value, because 50,000 or is equipment net is going to be the same as $50,000 salvage value. So even if I continue to go through and use the equipment, that's how I'm going to basically be, I'm going to be showing this on my balance sheet forever like this. So even if I keep on using the equipment for 2022, there's going to be right over here, this will be no entry, equipment is fully depreciated. And over here, for my accumulated depreciation on this equipment, I would just continue to show this balance here, 1/1/21, so maybe 1/1/22, and this will be 12/31/22. This will be 0, so my ending balance here would be 90. So when I'm going through and doing this, I essentially just have the same number just kind of repeating over and over again. Because again, even if I'm still using the equipment after that, you know, at one point in time, then I just don't do anything. I'm going to be leaving it on the books. Now, a lot of you might be saying, Tchaikovsky, you're crazy because what if the salvage value changes? What if the estimated useful life changes? I have a video for that. And, but that is all for this video for today. Remember, this is with equipment. Equipment, we need to, I had a student once ask me, he said, well, why don't I just expense equipment? The answer is, well, when you buy it. The answer is, for financial accounting purposes, tax is different, but for financial accounting purposes, when I'm purchasing equipment, I'm going to show that over here as an asset. And then I have to show the use of that equipment or that asset via depreciation expense. So I'm going to be debiting depreciation expense, crediting accumulated depreciation. How do I calculate it? It's over here using straight line. So when I'm showing over here is that, does my asset reflect my future economic benefit? I'm now showing my asset is showing having been used for a year. So in this case, my assets are starting to better reflect my, do they reflect my future economic benefit? At the same time, when I'm going through and debiting my depreciation expense, is that depreciation expense, is that now showing me my use or my expense during the period? And the answer is yes. I'm showing the use of the equipment during 2019. So again, that's how we go through and do adjusting journal entries when it comes to equipment. And I will see you on the next video. Please do not forget, thank you for watching. Please do not forget to like and subscribe. If you have any comments or questions, please send them to 1812cpa@gmail.com, and I will see you on the next video.